So today we're going to be looking at absorption costing and marginal costing. We'll start with marginal costing. Marginal costing is basically a method for estimating cost of production. Okay, so it involves using just the variable cost, the direct cost, all right, in estimating the cost of production. So let's look at this example. Makurdi Manufacturing makes and sells a single product. Selling price is 150 naira per unit. Variable production cost is 70 naira per unit. Fixed overhead per unit is 50 naira. And total absorption cost, or what we call the full cost, is 120 naira. So we have normal production of 2,200 units per month. But the fixed production overhead is 110,000 naira per month. So our fixed overhead absorption rate will be 110,000 divided by 2,200, and that gives us 50 naira. And that 50 naira is what we have as our fixed overhead per unit, 50 naira. Now we have the actual results for July and August, being fixed production cost of 110,000 in July and 110,000 in August, which is exactly what we budgeted for. Production was 2,000 units in July and 2,500 units in August, as against 2,200 units, which are budgeted production units. Our sales was 1,500 in July and 3,000 in August, whereas we plan to sell 2,200 units in both July and August. So if we look here now, if we have no opening inventory in July, what that means is that our total production in July and August combined will be 4,500 units. And our total sales in July and August combined will be 4,500 units. So with this, our closing inventory at the end of August will be 0 units. So that's what this narration down here is talking about, that there will be no closing inventory at the end of August. All right? So, but we have closing inventory in July as 500 units, and by the end of August to be 0. Now, prepare a profit statement using marginal absorption costing method. So we'll use the marginal costing method now to prepare a profit statement. So our profit statement, let's have a Naira sign here for July and Naira here for August. Okay. Revenue. What will be our revenue in July? Revenue in July, we sold 1,500 units in July. And what's the selling price per unit? Selling price per unit is 150 naira. So that is 1,500 multiplied by 150 naira. And that will give us 225,000. In August, we sold how many units? 3,000 units at the same 150,000, also 150 naira. That will be 450,000. Okay. Less our cost of sales. Cost of sales in July under marginal costing. Marginal costing makes use of variable cost. All right. So what's our variable cost there? 70 naira. And what's our production? Cost of sales Our production is 2,000. However, we are calculating cost of sales, so we still use the 1,500. So 70 naira, 1,500. Cost of sales here will be 1,500 multiplied by 70 naira. And here it will be 3,000 multiplied by 70 naira. This will be 210,000. Cost of sales will be in bracket, and here it will be 105,000. It will also be in bracket because it's cost of sales. The difference between these two, gross profit would be 120,000. 120,000 here, and here it will be 240,000. So these are gross profits under marginal costing. All right, so since we are doing a profit statement, the next thing we do is to calculate our fixed production overhead. Fixed production overhead, according to the question, is 110,000 in July, 110,000 in August. So let's factor that in. 110,000 in July, 110,000 in August. So our net profit will be equal to 10,000 in July and 130,000 in August. So these are profit statements using marginal costing.